Hello everyone, and welcome to today's lecture in our derivatives course. Today we'll take our understanding one step further and look at a combination strategy called the bull spread using call options. By the end of this lecture, you'll understand how this strategy works, why investors use it, and how it limits both potential profit and potential loss. A bull spread using call options is a strategy designed for investors who are moderately bullish. It profits when the price of the underlying asset rises, but only within a certain range. The strategy involves buying one call option with a lower strike price and simultaneously selling another call option with a higher strike price. Both options have the same expiration date and are based on the same underlying asset. Because the investor receives a premium for the short call, this strategy costs less than buying a call option outright. Let's review how to construct a bull call spread step by step. Step 1. Buy one call option with a lower strike price, which gives you the right to buy the underlying asset at that price. Step 2. Sell one call option with a higher strike price, which obligates you to sell the asset if exercised. The net result is a strategy that has limited risk and limited reward. The cost of the trade is the difference between the premium you pay for the lower strike call and the premium you receive for the higher strike call. The payoff of this strategy depends on the price of the underlying asset at expiration. If the price stays below the lower strike, both calls expire worthless, and you lose the net premium you paid. If the price rises between the two strikes, the long call gains value while the short call remains inactive, generating profits. If the price rises above the higher strike, both options are in the money, and the gains from the long call are offset by losses on the short call, capping your maximum profit. The maximum profit is the difference between the two strike prices minus the net premium paid. The maximum loss is limited to the premium paid to initiate the position. The break-even point is the lower strike plus the net premium paid. Let's go through an example. Suppose stock XYZ is trading at $50. You buy a call option with a strike of $50 for a premium of $4, and you sell a call option with a strike of $60 for a premium of $1. Your net premium paid is $3. Your maximum profit is the difference between the strikes, which is $10 minus the $3 cost for a total of $7. Your maximum loss is the $3 premium, and your break-even point is $53. If the stock closes below $50, you lose the $3 premium. If the stock closes at $53, you break even. If the stock rises to $60 or higher, you earn the maximum profit of $7. Beyond $60, gains on the long call are fully offset by losses on the short call, so profit remains capped. Notice the payoff line that starts flat below $50, rises steadily between $50 and $60, and flattens again beyond $60. This shape illustrates how profits increase gradually and then level off at the maximum profit point. The lower flat portion represents the maximum loss, which is the premium paid. Why use a bull call spread? It's ideal when you expect the asset to rise moderately but not dramatically. It reduces the cost of entering a long position compared to buying a single call. The short call reduces risk but also caps profit. The strategy's Greeks show that delta is positive but less than 1, meaning it benefits from price increases but with smaller sensitivity. Theta, or time decay, partially offsets between the long and short positions. Vega exposure is lower than that of a single long call. In summary, the bull spread using call options is a limited risk, limited reward strategy for moderately bullish investors. It's cheaper than buying a call outright, and safer because the loss is capped at the premium paid. However, it also limits potential profit once the price exceeds the higher strike. This concludes our discussion about the bull spread using call options strategy. See you at the next lecture.